Hi, everyone. I want to talk to you today about earnings, stock prices, and the voting machine. Earnings drive stock prices. This is a saying you're probably familiar with. It's one of the oldest sayings in markets. What it basically means is that earnings and stock prices tend to move together over time. And if we look at a long-term chart of earnings and the S&P 500, this appears to be true. They both have moved together higher over time. But appearances can be deceiving. And if you zoom in on this chart, what you'd find is that there are many years in which earnings and stock prices are not moving in the same direction. So we have years in which earnings fall and stock prices rise. We saw that in 1991, 2007, and 2020. And then you have years where earnings rise and stock prices fall. We saw this in 1994, 2000, 2002, 2011, and 2018. Most of the time, earnings and stock prices are moving in the same direction, but the magnitude is not nearly the same. And so what's going on here? Why isn't there a one-for-one relationship between earnings and stock prices in the short run? Well, you have changes in human emotions involved. So human beings at times become more excited about stocks, and other times they become more nervous or afraid. And when they become more excited or exuberant, they tend to bid up stocks and pay a higher multiple. When they become despondent, afraid, nervous, they tend to push stocks lower and pay a lower multiple. So from any given year, if we're looking at the stock market, what you'll tend to see is either an expansion in the multiple, if we're looking at the price to earnings ratio, or a contraction in the multiple. And these changes can be large. They're not often small changes. In fact, in 2/3 of the years we've seen since 1989, we've seen a greater than 10% change in that multiple, either 10% higher or 10% lower, in either in an expansion or contraction in that S&P 500 multiple. And the most extreme year actually occurred in 2020, where we saw a 22% decline in earnings, and the S&P 500 actually finished the year up over 16%. And so what was going on that year? Well, investors were looking ahead to better earnings in 2021. The stock market is a forward-looking indicator, and investors became excited about the stimulus programs and what that would mean for GDP and what that would mean for earnings. So the question, of course, that everyone's asking now is what will happen for the rest of the year? Where will the S&P 500 end the year? We like to think that there's someone out there with a crystal ball who can predict these things. But if we look back at history, the record of that is not very good. Let's take a look back at the last few years. In 2020, the S&P 500 ended the year at 3756. If we look at the analyst estimates entering the year, every single one of them was below this year-end S&P 500 level. If we look at 2021, the same thing happened. The highest estimate was 4,400 for the S&P 500, ended the year at 4,766. This year, we're seeing the opposite. The S&P 500 through the first half is at 3,785. That's well below the lowest estimate among Wall Street strategists. So what's going on here? Well, it's very difficult to predict where earnings are going to be, but it's much harder to predict the changes in investor sentiment. And what we've seen so far this year is a pretty big multiple contraction in terms of the S&P 500, where we've seen earnings up just a little bit if we're looking at trailing 12-month earnings, but stock prices down over 20%. And so this is really evidence that it's almost impossible to predict where the market's going to go over the short run. It's just impossible to say where that multiple is going to land. And the reason for that is there's many different scenarios that you can encounter. And so if we look at the estimates for earnings this year, we say that, oh, there's a reasonable probability of us achieving that. Well, then you have to say what investors will pay for that. And what we've seen over the last 30 years is a big variation in what investors will pay, from a low year-end multiple of 13 times earnings to a high of over 30 times earnings. So depending on how investors are feeling at the end of this year, you can see an S&P 500 below 3,000 or above 6,000. Now, that sounds like an enormous range and much wider than anyone would expect. But that's the case in markets, and that's assuming that these earnings estimates are correct. If earnings are actually go down 20% versus consensus, or 20% above consensus, well, then you have an even wider range of expectations. And so if you're going to predict where the S&P 500 is going to be, make sure you have a wide range on the low end, on the high end, if you want to be correct in that prediction. So in all, what this means is that Graham and Dodd were correct when they wrote in 1934 that the stock market is a voting machine rather than a weighing machine. And as long as human beings and their emotions are involved in markets, it always will be.